Welcome back to another video. Today we're going through 6 stocks that I'm adding to really quickly, and then we're going to go through Progressive. That is the one that I told you guys yesterday that I was adding to. So I just want to go through my bull thesis and just show you what I think about Progressive and these other stocks that are very cheap. By the way, shout out to PPC Ian. He kind of reminded me that I had these in my portfolio, and I'm always on the lookout for new stocks, but sometimes I have to look at the oldies and see what they're doing, what their price action is looking like. So if you like these type of videos where I show you guys what I'm buying and what I feel like is cheap and a good deal out there in the market, great companies, hit that thumbs up button. But let's get into this. Number one is ABBV. Okay, so as we can see there, selling for pretty cheap right now, right? 8.51 PE, forward PE for 2021, 4.9% dividend yield, and a 41.8 payout ratio. So the thing that I like about this, obviously besides the good yield, is that I think it's a very steady business, and I think that it's highly disrespected with this price. There is some risk when it comes to pharmaceuticals, but I think that this thing is still priced pretty cheap. It's had a huge run up, but I think it's still very cheap. So I like to buy some things, like most of my portfolio is either index funds or very defensive positions, ones that I don't think that they belong as low as they currently are. Next one is Altria. So for you guys out there that don't know, Altria is the maker of Marlboro. So they sell cigarettes. They've also made a dip into the marijuana industry, which is a very volatile industry right now. But I do like that they're looking forward. Their Kronos investment has not been the best so far, but with legalization probably around the corner, I do like that they're willing to dip their toes. So that's what I like about Altria. They're talking about Marlboro, they're looking at Kronos, they're looking to acquire marijuana companies. So moving back into General Mills. General Mills is one that I don't think I actually own this one. I have owned it in the past, but as it starts to get a little bit cheaper, everybody knows what General Mills is. They are the cereal maker, and they do their thing, right? They're a great company, good solid company. Selling for very cheap right now, 16.39 forward PE, and it has a pretty good starting yield there. So moving on to the next one, Pfizer. So Pfizer, you may think that it's just a drug company, but they actually do a lot of other things. So let's look over here at the Pfizer products. A lot of this stuff is very recognizable. We got our vitamins and some drugs that are commonly used. Everybody knows about this one right here, Listerine. That's something that you may not have known is Pfizer. Take some Listerine, you swish some of that, brush your teeth up right here. You know, take about, what's that say, 4? Take about 12 of those, and you're good to go for the night. Moving on, British American Tobacco. So I wanted to show you guys the products on that as well. Look, we've got 11.12 forward PE for 2021, and we're looking at a 7.5% yield. So especially in my retirement accounts, I really like that guaranteed yield. Payout ratio is a little bit high, but they do pay out a lot of their profits. That's kind of the company that they are. They are not a growth company. They're paying out their profits. So let's check out these products. A lot of these you're going to recognize, like Newports. People recognize Newports. Camel. Everybody recognizes Camel. Grizzly. If you're in the military, you know exactly what Grizzly is. So what I like to do when I look at these companies is, you know, when you recognize these brands and the stock price starts moving, you know American Spirit, you know Newport. You see people smoking Camels, chewing Grizzly every single day. And they're also moving into the vape space, which I really like as well. So they're looking to grow in that way, and they're looking to improve margins. So I do like this company just because I think that they have a very lasting business model. If you actually look at what's happened during the pandemic, people have been increasing their substance usage, such as alcohol, such as tobacco. And, you know, when people are stressed, they want to have some of these products. So moving on, AT&T. We got a 9.7% forward PE for 2021, 6.86% starting yield right now, and a 55% payout ratio. So that is a moderate payout ratio. The reason why AT&T is so cheap is because they've made some bad acquisitions. Now, recently they just sold out of DirecTV, which I think was a great move. I'm pretty excited about what they're doing with HBO Max, and their CEO's name is John Stankey. You can't beat that, all right? Every time I hear him come on the earnings calls and I hear them say John Stankey, it's the kid in me, guys. It's the kid in me. So I think that's it for these stocks, and then we will move into the feature presentation, Progressive stock. So we'll start out here with the free cash flow. I believe this is the thing that I showed you guys in an earlier video. If we look at our free cash flow over time, we see that it is up and to the right. That's a great sign, right? They've been growing their free cash flows aggressively. The thing that really caught my eye about Progressive is that they have a really nice dividend yield. They have a 4.81% dividend yield, and their payout ratio is not excessively high. It's at about 62.35%. So we can expect that they'll be able to, if they keep on growing free cash flows, they'll keep on growing the dividend, and it's already at a great starting yield. So even though this stock has been running up, I still like it here because they've been growing their free cash flows in such a way that definitely justifies this price. Their price to earnings multiple is not that high. Their price to earnings multiple, according to MarketBeat here, is only 11.1. So it's selling at a good price. It's growing the dividend. It's growing the company in general. So it just looks really good here. And now MarketBeat wants me to sign up. I will not. Okay, so a look into their dividend history. So what we see here is they pay a very tiny dividend, and then they usually pay a special dividend here in January. So that's what they've been doing since about 2019. They've been paying special dividends around January, February timeframe. So they pay a small dividend and then they pay out a special dividend. They are a special little snowflake because they are an insurance company. So anyways, moving on, let's look at the current ratio. So the current ratio is basically the current assets versus the current liabilities. If you look at them versus other insurers, this is Chubb, Allstate, and MetLife. They have some of the best current ratio out there. So the reason why their current ratio is so bad is because, like, compared to other companies, other types of companies, is because insurers, they have a lot of liabilities because they have claims that could be claimed. So the way that their balance sheet looks, essentially, it's good to see that this one is the best balance sheet out there among the big insurers. So just the way that insurance works, essentially, you have a lot of liabilities, a lot of claims that could be made against your current assets. So that's kind of why this looks worse than you would normally see with, usually you would want to see current assets cover current liabilities, but it's just a little bit different in the insurance game. All right, net profit margin. So we see that everybody took a dip over here in 2008. So what we want to see is we want to see that profit margins are going up. And what we see now is that as they've changed their business, as they've revolutionized the insurance business, you can see that their profit margin has gone to the top of the heap. Moving on, we see that they had a tough time over here in the recession. They were making negative profits, but then you see that right after the recession, they went right back up, and you see a steady earnings per share growth over time. Looking at the PE ratios, we see that MarketBeat has them at a 9.76, whereas MetLife is lower at 8.19, Allstate is below them, and Chubb is the highest at a 19.67. Now, you're going to have to pay up for quality. I'm not sure why Chubb is selling at such a high multiple, but they are one of the largest insurers in the world. So back into the stock screener here, we see that a lot of them took a dip right here in 2008 during the recession. That's something that I'm interested in because who knows, we may go into a recession, or the government may print us so that we don't ever have a recession ever again. Everything's all good. Moving on to the revenue growth, which is something that you like to see. You like to see them grow in the top line. We see that Progressive is starting to overtake Chubb. We see that they're heading for Allstate, and MetLife has been up here at the top for a while, but their growth is not very impressive. We see that they've grown revenues by about 50% in the past, looks like 12 years. Whereas in the same time, Progressive has had about a triple up in revenues. As far as profit margins go, we see some unprofitable quarters during 2008. But over time, we've seen that they've improved their profit margins, and they've become the most profitable insurer as far as net profit margins. All right, and the last thing I want to get into is return on equity. And just so that we're all on the same page, return on equity is a measure of financial performance calculated by dividing the net income of the shareholder's equity. Because the shareholder's equity is equal to a company's assets minus its debt, ROE is considered a return on net assets. So it's basically the return on what you own as the stockholder. So let's check it out. We see this dip in 2008. We see that Progressive has been getting the best return on essentially the stockholders' capital of any other insurer. So I think this company is, generally speaking, just a beast. It's only getting better. They're paying out a pretty massive dividend. They pay out that big special dividend every January or February. And I think I'm going to make a lot of money on this company. I want to own it for the long term. And I'm really not seeing any barriers to this company's growth. So I think that it's going to be a very safe one, a very defensive play. I'll probably be putting in anywhere between $300 to $1,000 into Progressive. So I'm pretty bullish on this one, right? So anyways, hopefully you guys liked this video, got something out of it, enjoyed the charts and everything. and I'll see you guys in the next video.